All right, Caleb, I'll be pushing the broadcast live to the platform in about 30 seconds. Nothing really for you to do. I'll just reach back out to you about a minute, 15 seconds before the event starts.
Okay. But all they're seeing is the slide right now, right?
That is correct, yes.
Cool. Thank you.
Thank you. And I'd like to welcome all those just logging on. Thank you so much for joining us today for Money Show's Virtual Expo. We do have about 3 minutes, 3.5 minutes before the presentation begins. So sit back. We'll be right back with you with a fantastic presentation here. Caleb Silver's with us. So stick around. We'll be right back with you. All right, Caleb, we're about a minute and a half out. If you want to go ahead and take the screen share, I'll just verify everything looks good. All right, slide looks good. Full screen there.
Yep. How do I sound? I just changed mics. Am I right?
Yep, audio sounds good. Loud and clear.
Cool.
All right,
All right.
so I'll lead momentarily with an introduction. We'll be all
And I'll
set.
drop the share, right? Yeah.
Okay. All right, everyone, welcome back. Money Show is pleased to welcome Caleb Silver. He is a business journalist and the editor-in-chief of Investopedia. He previously worked as the director of business news at CNN, the executive producer of CNN Money, and was a senior producer on The Situation Room with Wolf Blitzer. Caleb, such an honor to have you here today. Thank you for taking the time out. It's all yours, sir.
Thank you. It's a real pleasure to be here. Special thanks to the Money Show. Special thanks to you for setting up this session and all you folks who attended. I wish we could be in Vegas, but we'll be back there soon enough. But it's a real honor to be presenting on behalf of Investopedia and be talking to y'all. I'm going to share a screen. I'm going to talk about some of the trends we saw in 2020 as we looked at our investors, as we looked at our readers. We have about 23 million readers, and we looked at what they were looking for amid the ups and downs of the market. It was an unprecedented year, as you all know, and we're going to get into that now. So let me try to share a screen here, and we will take it away. Hopefully you're all seeing that. Well, you don't need me to tell you that 2020 was a pretty wild ride. You could pick your superlative. You could pick unprecedented. You could say black swan. You could say once in a lifetime event. It was all of those things. And it was a really wild ride for investors, obviously. Remember those market lows back at the end of March 2020, with the stock market hitting the fastest bear market in history and then recovering in the fastest recovery in history. That was enough to give you some whiplash. And we were tracking that throughout. And we had to redo this chart about 5 or 6 times, but just some of the major events that went on in the past year in 2020, from the first confirmed cases back in late January of 2020, the market was still sort of holding up. We were kind of coming through those trade wars, and then we had the cases popping up in Washington and around the United States and throughout Europe, and then the market really started to take off, and then the emergency was declared. Obviously, we know what happened after that. Economies went into a lockdown. Basically, business came to a standstill. We stopped moving around the country. We stopped traveling around the world. Business travel ceased. Everything stopped. And the stock market went on that historic plunge. But then came historic stimulus, historic monetary policy, historic fiscal stimulus. But it was really sketchy, really touch and go there for a little while. But the stock market reacted as investors always anticipate the recovery. They were way out in front of it. We saw those stimulus bills passed with the first CARES Act. We saw Fed support back in April of 2020 with the Fed basically saying that it was going to get the back of the securities market by buying what we call quantitative easing, buying corporate bonds, buying government bonds, buying mortgage bonds, basically becoming the buyer of last resort and holding those interest rates down at zero, plus pushing money out to small businesses around the country and to banks around the region. Then we saw this massive recovery, as you all remember, throughout the summer and the fall of last year. But it was a pretty volatile recovery. If you remember when President Trump tested positive for COVID, we had all these things happening. The election, obviously what happened on January 6th, all these things were a big deal. And it was really meant for a wild ride for investors. But at Investopedia, we have a really unique angle and unique viewpoint on how investors, and these are retail investors, me and you, are engaging with the market. And we track that a number of ways. But one of the key ways we track it is through measuring what we call anxiety. Anxiety, not in the, are you visibly shaking anxiety, but what are you searching for? So we track words that have kind of anxiety written all over them across the economy, macroeconomy, across markets, and across personal finance. So think about things like mortgage bailout, think about things like bear market, think about words like correction, think about words like foreclosure, forbearance, all of these terms that investors and our readers, and there's 23 million of them around the world every month, start to look for when they get worried about things. We track that in what we call the anxiety index. So there's a look at the anxiety index. Looks a lot like the stock market, but more extreme, because people come to Investopedia, as many of you may have in your past, to learn. What does this thing mean? What does this thing do? How do I invest? How do I avoid? How do I protect? We saw all that activity happening, but what we really saw was this spike in our anxiety index to record levels back in the depth of the crisis, back about 13 months ago. We'd never seen anxiety like that, as people were searching for those anxiety-based words and those fear-based words because they were really worried about what was going to happen to their money, and for good reason. Some crazy things happened. So we were tracking it through anxiety. But we also started surveying our newsletter readers. We're lucky enough, we have 1.5 million daily newsletter readers and about 5 daily different newsletters that go out to them for investors and traders of different levels. But we've been surveying them the entire pandemic to see, not only what they were fearing in terms of anxiety, but what they were doing. So we were checking their bullishness or bearishness. We were checking their confidence in the stock market. We were checking their favorite stocks or the sectors they wanted to avoid. We were asking them where they felt their bubbles were forming, where they felt like there was the most opportunity. And our readers, bless them, there's like I said, about 1.5 million who read our newsletters every day. They were responding to us and giving us that finger on the pulse. Besides what we were seeing on site, this was a direct conversation. So back when we started surveying them in April, they started getting pretty scared. 31% only claimed to be bullish, and I can't blame them. We had far more bearish readers than bullish readers. We had people who were sort of in the middle and stuck and didn't know what to do. But they started flying to safety. And you could see that in the equity markets. You could see it in the capital markets, as obviously gold went on a tear. You could even see it in some safe securities, like some treasuries, like cash. A record money went into cash. It was hiding on the sidelines while people were freaking out during March and April, but for good reason. But then, as we know, as things started to open up and we saw those stimulus packages passed and we saw the government stepping in an unprecedented way, we saw companies pivoting to be able to deal with the pandemic, that opened up a lot of new opportunities. And our readers, who are, as I said, retail traders, got very opportunistic and very promiscuous. They're typically blue chip investors. If you can see the chart on the right, they love their Apple, Microsoft, Amazon, Disney, J&J, Bank of America, these storied legendary stocks with big market caps. That's where they hang out. But they got super promiscuous with a lot of stocks that went on a deep discount throughout April. And this wasn't just our readers, but our readers are a good representation of retail traders and investors in America and around the world, frankly, but we're surveying only the US readers. So they started buying things like the airlines. They started buying things like some of the cannabis stocks. They started buying things like some of the oil stocks, just as they went on this precipitous decline. Our readers started to get very opportunistic. And it wasn't just young readers, it was readers at all ages who have different levels of investing. They leaned right in to the fear and started buying stocks, which was wild to see, but the conversation we were having them throughout this crisis was so eye-opening for us. We saw this change in their behavior too, not just about what they were buying or how they were feeling, but about what they were looking up and looking for opportunities in key sectors to take advantage of buying opportunities in ETFs and individual stocks, but they also wanted to know what the heck was going on. And I spent a lot of time in the past year going on TV and the radio and podcasts, trying to explain what was going on, because as I said, it was a super unprecedented time. So as volatility was sort of raging and then cooling as we got into the late spring, our readers started looking up the terms that surround volatility, corrections, how to buy put options in case they wanted to continue to bet against the market, catching a falling knife. What does that even mean? I started to go around in financial media and in mainstream news. I had to explain what that meant. That meant you're trying to catch stocks on their way down, trying to find the bottom before they go up. That can be pretty dangerous. People were buying the dips and looking up how to buy the dips. They were looking up equity risk premiums. Was it worth more to invest in the stock market now or to stay in treasury bonds? Well, obviously the equity risk premium diverged greatly as the stock market rallied to record highs. So people were looking at it, but they were also looking up a lot of these, kind of dangerous, so to speak, but I would say risky securities like inverse volatility ETFs, like leverage inverse ETFs. You saw some of those products flying off the shelves, and you saw inflows, not just what they were looking up on our site, but we were watching inflows into the capital markets, into ETFs and mutual fund strategies that showed that people were trying to find ways to capitalize on these big dips across these sectors: gold, airline, transportation, energy. If they bought those dips back then, they did pretty well. But what's so fascinating is to see that reaction, that chain link reaction of deep fear causing anxiety, people looking up fear-based terms, and then wait a second, there's an opportunity here. The light switched, the light went green, and they started looking up ways that they could capitalize on the opportunity. 2020 was also a year where there was so much momentum investing. It was tough to pin down stocks for their fundamentals, because fundamentals by and large went out the window. It was hard to find, the right PE ratio or price to forward earnings ratio or price to sales when business basically came to a standstill. So what stepped into that gap? A lot of personalities. It was really the cult of personality driving a lot of the securities market in 2020, in addition, obviously, to monetary and fiscal stimulus, in addition to just behaviors by investors that you would see in that type of an environment, the animal spirit sort of running wild. But think about some of the things that happened, and it's hard to even remember that this happened in 2020. Seems like forever ago because it was such a long, arduous year. But let's just take it back to Netflix's Tiger King. Remember that? One of those characters, he's pictured there with the tiger. He mentions a $500 bill and pulls out a $500 bill on Tiger King on Netflix. We got search activity on our site, the likes of which we haven't seen in years, for people looking up whether there's an actual $500 bill. And the answer is they don't continue to print them, I don't believe. But there you go. A Netflix show causing all this activity onto our site. I'm talking about, hundreds of thousands of page views of people looking up that currency. Succession, obviously a very successful show on TV, pun intended, one of my favorites. But there was talk in one of the episodes about the poison pill, as Logan's son tried to wrest the company away from him, in a bear hug as he tried to steal the company, in the middle of his sister's wedding. So we got a lot of traffic to terms like poison pill, like bear hug. Succession and Billions, the show on Showtime, terrific show on Showtime. Those two shows drive so much traffic on Investopedia because pop culture has this way of making people want to learn and get smarter sometimes. And thankfully, they came to us to figure out what that was. You remember Dave Portnoy of Barstool Sports? All of a sudden, there was no sports. There was no sports gambling. That's his game. When that didn't happen, when that went away, he went right into day trading, and he went into it pretty hard. He started streaming and YouTubing his trades throughout the day and commenting on them, claiming he was a better investor than Warren Buffett. But he was representing millions of new day traders coming into the market for the first time, either because they had time on their hand, they had extra money on their hands because they were getting stimulus checks, they were home because we couldn't be at work. There was no sports to bet on. So the stock market became a casino for many people. And we know how that turned out. But a lot of people made a lot of money if they came into the market and invested for the first time and did it wisely. But Dave Portnoy of Barstool Sports was sort of the poster child for that activity. And, like I said, there was about 10 to 15 million other brand new traders who started trading for the first time. How do we know that? We know that because they were also coming to Investopedia to learn how to invest $10,000 for the first time, how to buy in ETFs, how to short stocks, how to start their own investing accounts. Should they get a robo-advisor or an online broker? They were pouring into our site. We had record traffic last year as people were looking for those answers to get started. Fast forward to 2020 and the vaccine approval started kicking off. Remember, the markets were making record highs after record highs. The election uncertainty was everywhere. But once it became pretty clear that President Biden was going to win the election, and then it became even clearer that he might have a blue wave, we saw the markets take off, especially around the recovery, but even in the green sectors, green energy and cannabis. But then we saw those reopening stocks that were left for dead, that our readers were picking up in April and May, take off on a record binging run. So it was cruise stocks, it was transports. Dow transports are still on a record-breaking run right now, but the cruise lines, the airlines, anything that moved cargo, anything that moved people started rallying, and our readers, and I think investors in general, were banking on this recovery rally. And now the rise of TikTok, you can't ignore that. And we started our own channel last year as well. TikTok hashtag, the hashtag investing has over back then it had 1.6 million views, as that app saw this surge in activity of people giving advice, people telling you what to do with your stimmy money, people telling you which coins to buy, why you should buy Dogecoin or why you should buy Bitcoin. It became, again, the cult of personality on a very engaging platform. Something about TikTok and the way that algorithm works, it really serves up the kinds of things that I think pretty intuitively, but that platform grew like nuts. And then people who were on that platform becoming successful moved over to other platforms like Twitter, like Instagram. So you saw this retail investor not just being influenced by traditional media anymore. It was sort of a harken back to the late 1990s and early 2000s, when we had the online forums for trading and day traders really got their start. This was happening across social media and it couldn't be stopped. A lot of people lost a lot of money in that mayhem, but there was a lot of people who came into the market for the first time and really did want to learn how to trade, how to invest, how to do it responsibly. So you take, you want people to want to learn, but you can't stop the fact that so many people are trying to come in and make money. And basically, that's why a lot of people participate in the market. And then, of course, who can forget what happened with Wall Street Bets and Reddit as we got into December and January? Really, GameStop was the poster child of that mania. And GameStop, really, that activity started in October and November when Ryan Cohen, the CEO and the chair of Chewy.com, started agitating the board to become a more direct-to-consumer online site versus the mall site, because no one was going into malls. But then the activity around GameStop and around the shorted stocks went bananas, and we've never had traffic like that in our life as a website. And we are 23 years old, so that tells you something. People were so darn interested in what hedge funds do and what short sellers do and what a short squeeze is. We started creating TikTok explainers about these things as well, and those were getting 100,000 views, 150,000 views. It was an unbelievable few months there when we had this surge in activity and people really wanting to know what was up. Cut to January 2021, and you couldn't throw a stone and not hit water when people looking for short squeeze stocks or popular stocks to short. And we were asking our readers through our surveys whether they were doing any of these activities. What was their favorite securities? What stocks were they actually experimenting with? And like I said, a lot of these are blue chip holders. A lot of our readers are, age 45 and above, living throughout the United States, but they are tried and true blue chippers who also like their dividend paying stocks. They'd like to understand what they own. They didn't care in this case, a lot of them. And this was readers from the age 21 to age 81 who were experimenting with a lot of these short stocks that got beaten down. So it was really an unbelievable thing to witness, the amount of risk and the appetite that our readers had. And I think you could say this for all retail investors, to buy into risk was something like we've never seen before. It's not a mistake that, we had more 401k millionaires than ever before last year, but a lot of them didn't get there by investing in these stocks, but they couldn't resist the temptation of these stocks that were moving sometimes 80, 90% in a day. At one point, GameStop was up 500% in a short multi-week stretch. So, it's hard to calm your animal spirits when you see that type of activity happening. And then if you look at some of the gains some of these made, it's hard to understand. It's easy to understand why people would want to get involved with them. But, at the same time, people were taking risks they'd never taken before in their portfolios. And there was a lot of new traders who were getting into this via the online brokers that were experimenting with shorting stocks for the first time. And it's an easy way to lose a lot of money. We had this perfect storm of events happening, which was obviously the pandemic shutting down the economy and the crash in the stock market. But you also had the confluence of other events, which was 2 years ago, 2.5, almost 3 years ago now, many of the online brokers got rid of trading commissions, which basically opened the floodgates for people to trade as much as they wanted without worrying about those fees. And we also had the advent of fractional shares too. So you didn't have to wait till you could afford a $3,400 Amazon.com stock. You could buy $10 worth of Amazon. And then you had, the explosion of platforms like Robinhood that were bringing new traders to the market for the first time, but we're also celebrating every time they placed a trade by spraying virtual confetti at them and making it seem like it was a little bit of a carnival. Well, some of those behaviors were relaxed, of course, but we also know what happened, when regulators started looking into GameStop and looking into what was happening inside the markets. It was normal market activity, except it was, amplified by so many people on these social media forums who were championing these shorted stocks and trying to stick a finger in the eye of the hedge funds out there, that it was sort of this battle between, little investors and bigger investors and the established investors, which was entertaining to watch, but it was also an opportunity to educate people on what they really didn't understand about the way the markets work. So we saw a lot of that activity happening. By March, our investors, and I think you could say this about retail investors, and you could say this about institutional investors, they were never more bullish in about the last 10 to 12 years in terms of their appetite for risk, their appetite to want to own stocks, and their belief that the stock market was going to keep rising. They just held on to that notion that because interest rates were down near record lows and are going to be held there until 2023, because there's so much money pouring in to the market and into consumers' hands via fiscal stimulus, and because of so much monetary policy, monetary policy stimulus coming in, but also a Biden administration that loves to spend and has promised about $6 trillion in spending. They just bet that that was going to be nothing but bullish for equity markets. And they were right, as stock markets, went on to make record highs up until a couple of days ago. Today's a different story. May have come too far too fast. But the bullishness in our readers was at an extreme. It was that way for the American Association of Individual Investors. It was that way for TD Ameritrade's customers. It was that way for institutional investors that were surveyed by Bank of America. When everyone is that bullish, that side of the boat starts to tip a little bit, and we're starting to see that pullback right now as markets seem to be correcting, especially in technology stocks, which are down about 6%. Not correcting yet, but they did hit what we call resistance on the way up, so to speak. But anyway, readers were bullish, and we surveyed them pretty recently as well, and they were just as bullish. But we started asking them different questions about what they thought the biggest risk was. Obviously, a year ago, the biggest risk was COVID and the COVID related shutdowns in the economy and the uncertainty that that created. Well, as we got into November, as we got into December and January and February, the biggest risk became political. Our readers, and I think a lot of retail investors, started worrying about political uncertainty under the Biden administration. But what they were talking about really was taxes. President Biden campaigned on a promise to raise taxes for the rich and a promise to raise taxes for corporations. He's trying to make good on that promise. Our readers know what that means in terms of what happens to profit margins when taxes go up, but also what happens, to their returns once capital gains have to be factored in. And if those capital gains are rising, they know that that's not going to be great for their overall return. So they were worrying about that. They were worrying about inflation a couple of months ago too, when it just started bubbling. They can be pretty worried about it now. It's red alert. Not really. It's still under 3%, but everybody's worried about inflation because prices are rising. They were worrying about rising interest rates, even though the Fed has promised not to move them. They were worried about geopolitical tensions. And how about the 3% who were worried about a cyber attack? How prescient were they, given what we saw just this last week with the Colonial Pipeline? But I think at that point, they were worried about cyber attacks as it related to the Federal Reserve and the Treasury. I believe the Treasury was the victim of the cyber attack. But what we really saw in 2020 was this, risk-averse millennials jumping into the market, but the biggest increase in traders over 55 years old. And I talked about this several times to the financial media, and we wrote about it a lot. We have a pretty good sense of who a lot of these traders were. And these were not, young 20-year-olds or 19 teenagers home from school because their school shut down in the basement, playing video games and trading stocks by and large. Yes, there were a lot of them, but these were older folks. These were folks 55 and older living throughout the United States with pretty sizable portfolios who are learning to trade and invest for the first time. They may have already been passively invested. They may already have had a financial advisor. They may already have retirement accounts, 401ks and the like, but they were learning how to invest do it themselves for the first time because of this fear of missing out on the big runs we saw in a lot of those risky securities. But the interest was in the stock market was doubled for us across the board. And so did new account openings for the online brokers. So a third of new brokerage accounts was 25 to 34-year-olds. The greatest interest in opening new brokerage accounts were folks 55 and older. So that's interesting news for the online brokers out there who've been for years trying to get to millennials, trying to get to younger traders so they could build a lifelong journey of investing in a customer relationship with them. Well, the people with more money and more experience actually came into the market more aggressively, and that's where a lot of the signups were. And if you look, yes, Robinhood took a lot of market share in the last year, but we also saw enormous growth from Schwab, from Fidelity, from Vanguard, from TD Ameritrade, from Interactive Brokers, from M1. All the online brokers had increased activity last year, and it wasn't just young folks. It was so interesting to see this older cohort of people trying to make money, and a lot of them were around for the 2008, 2009 great financial crisis. They lost a lot of money back then. Many of them have admitted that to us, and were in some cases trying to use the rally and the optimism behind the stock market to recoup some losses from 12, 13 years ago. So this fascination with trying to jump back in and make it back was fascinating to us, and an interesting story to tell for financial media. So where are we now? Well, as of last week, when we closed our recent survey, our readers are more bullish than a Garth Brooks concert. They have been leaning into the stock market big time, and we're starting to see some cracks in it today and yesterday for the first time in a while. But 48% of our readers claim to be bullish in our last survey 39 were even mixed. Only 13% were bearish. That's a 4-to-1 ratio. And any contrarian investor will tell you, again, when everyone's leaning to one side of the boat, it's time to lean the other way. Or Warren Buffett will tell you, when everyone's being greedy, good time to be fearful. When people are fearful, good time to be greedy. Well, people are as bullish as our readers are as bullish as they've ever been, even though 61% of them think we're in a bubble. Where they think that bubble is, though, is curious. They don't necessarily think, by and large, that it's the equity market. Only about 30% said that. 40+% think it's in cryptocurrency. About more than that think it's in Dogecoin. And Dogecoin went on that great, unbelievable tear, only to fall 30% during Elon Musk's SNL performance the other night. 56% plan to continue investing the same amount that they've been investing. And these are pretty consistent investors doing monthly contributions, either dollar cost averaging in or buying more of their favorite stocks at whatever prices they can get them. But they plan to keep investing. Oops. And 61%, again, expect those higher corporate taxes. I think that horse has left the barn, so to speak. 55% expect those higher capital gains taxes. All of that said, as of last week, they were still, by and large, very aggressive, very bullish, and expecting more gains in the stock market. So to sum it up, crazy volatility in 2020, a record amount of new investors and traders into the market. We had people, millennials who'd kept cash on the sidelines since 2008-9, putting cash in. We had older traders coming into the market for the first time, older and affluent, who were moving assets from sort of safer places, whether that was cash or money market funds or gold, into the stock market. And then this change of strategy throughout the year from extreme fear to extreme greed and promiscuity as they chase some of those stocks, some of those beaten down sectors, and then they chase the day trading meme stocks, and then they chase cryptocurrency. Everyone, though, a lot of people, even if you've been in this market for a long time, 2020 made us realize the investing game has changed. The way we experience the markets and the way markets move now, given this influence of so many new investors and traders online and in other forums, that's a big deal going forward. And then we still have uncertainties, and the disconnects between the stock market and the economy, have never been greater. Yes, the economy is roaring back, but if you look at what happened in the jobs report the other day, there's still some weakness there, and there's weakness under the surface. Even though the recovery has been aggressive and there's been a lot of money put into the market, it has been an unbelievable year, but a year of education, and a year of anxiety, a year of learning, a year of massive losses and big gains, but most of all, this year of financial and investing education, which has really been for us a privilege to sit here where we sit and serve up all this content. So I'll stop the sharing now. And if there's any questions, I'll take them.
All right, Caleb, thank you so much for that fantastic presentation today. We had a question here. They're wondering, will the robust U.S. recovery, will it alter the Federal Reserve's policy stance?
That's the debate right now. And there's a lot of folks talking about it just today because the Fed has said it won't be raising interest rates till 2023 at the very, very least, or the overnight lending rate. The question is, will it stop buying $120 billion worth of government bonds every month and into what could lead to what we call a taper tantrum? So far, they said they're not going to touch that. They said that last week. They've been saying that over and over again. They're going to continue as is, for a while until unemployment gets down to full unemployment. For them, that's about 4% for the Fed. And we have some stabilization in inflation. Inflation, even though it's everywhere, it's not where the Fed wants it to be, like to be a little bit higher. So it's not going to move anytime soon.
All right, perfect. Another viewer here, they're wondering in your data, they say it showed interest, in quotes, in new brokerage accounts for different age brackets. They're wondering, was that actually new accounts?
Yes, that was new accounts. There was a lot of switching, though, going on with folks who are with a broker that they started with, perhaps, and they wanted to graduate to one that had more tools. Or even around the Robinhood controversy around the GameStop, we saw some folks looking at our reviews, Robinhood versus Fidelity, Robinhood versus Schwab. We do these head-to-heads. So we saw a lot of that traffic as people were considering moving brokers, either because Robinhood in some cases halted trading. Some of the other brokers did as well, to be fair. But I think there was a little bit of backlash going on there. But by and large, these were folks starting new online brokerage accounts and new robo-advisor accounts as well.
All right. Another viewer here, they're wondering, what does the Great Reset mean or refer to?
The Great Reset is folks planning on the reopening of the economy and knowing that life was going to change. And in that change was going to be a bunch of new investing opportunities. Obviously, we saw what happened with the stay-at-home stocks in 2020, the Zooms and the Pelotons of the world, and the Shopifys of the world. But this was about resetting so that they were well positioned for the sectors that were going to experience the recovery the most robustly, but also rethinking their risk profiles in general, because a lot of folks realized they missed one of the great stock market rallies of all time in 2008 and 2009. And they saw what the Federal Reserve was doing this time around, which had learned its lessons from the past. And they realized there could be a big rise in the equity market. So we saw a lot of folks resetting for the rally. And I think by and large, a lot of folks who did that responsibly did pretty well.
All right. And another question here, with the states looking for ways to get those unemployed back into the working force. We know there's a lot of people that just currently don't want to. Will U.S. job figures continue their upward trajectory?
Well, we hope so. And, we hope that April was just a blip. And, we thought there was going to be over 1 million jobs added. Obviously, we only got 266,000. But a lot of the other, I should say, measures we look at in terms of employment, we're trending in a better direction. Weekly unemployment claims were lower week after week. Private hiring was rising. There was 800,000 jobs hired in the private sector. The fact that the job report was so weak last month makes us think that maybe that was an anomaly, and we'll see a better jobs report in May. At the same time, there's a lot of jobs opportunities and availabilities out there. If you look at the JOLTS report, right, the turnover ratio, there's a lot of openings out there, and companies will tell you they can't find enough qualified workers. So we're in this kind of paradox where either folks don't want to get back to work because they don't feel safe, or they're making more on unemployment, or they just can't find the job they want. And companies saying, we can't hire enough people to operate at full capacity. So hopefully there's a breakthrough there, and hopefully we see it in this month.
All right, perfect. Well, Caleb, that puts us right at about time. Thank you so much for a brilliant presentation today. Thank you for taking the time out and being here.
Thanks for having me. And thanks again to the Money Show and for all the attendees. Enjoy the rest of the conference.
All right, everyone, thank you for joining us. We were speaking with Caleb Silver of Investopedia. You're watching Money Show's Virtual Expo. Thank you so much for being here. Stick around. We'll be back with more great content coming to you shortly.